The money in your bank account wasn't actually there. This isn't a metaphor or a conspiracy theory. If every customer went to their bank tomorrow to withdraw their money, the system would collapse within hours because it wasn't there. This wasn't an accident or a mistake. It was the game of the global financial system. It's so old and ingrained that we now accept it as normal. It's called fractional reserve banking, the silent, ongoing engine behind global debt, the inflation, and the illusion of wealth. When you understand how the system works, you'll understand that money itself can never be fully tangible, but is simply promises and numbers. To see where it all began, we need to go back to pre-digital Europe in the Middle Ages. Back then, money was gold and silver. The wealthy kept their coins or tradable valuables in chests, but carrying gold in a bag was dangerous and risky. So people began leaving their valuables with jewelers who had safe deposit boxes in exchange for receipts proving their deposits. Soon people realized they could use these receipts instead of real gold. They were lighter and easier to carry. Jewelers realized something. Most customers weren't withdrawing their gold at the same time. Most of the deposited gold was simply sitting there. So jewelers began issuing more receipts than they had, lending the extra receipts at interest and profiting from the non-existent gold. They were essentially creating money out of nothing. This practice laid the foundation for modern banking. The Bank of England was founded in 1694, not to serve the public, but to finance the government's war debts. The United States and other countries followed suit. Banks kept the economic system running by circulating money they didn't actually hold. Today, banks no longer lend from deposits. They create credit and credit your account directly. This money exists because you agree to repay it. More than 90% of the money in circulation today is not central bank money. It is debt created by banks. This has three major consequences. One, inflation. As banks repeatedly reproduce the same currency, every dollar loses value. Two, perpetual debt. Money always enters the system as debt, and interest ensures it's never enough to pay it all off. Three, concentration of power. Banks collect interest on money they never actually own. Governments borrow. Wealthy asset owners benefit while ordinary workers lose purchasing power. History doesn't repeat itself exactly, but it does rhyme. The goldsmiths of the Middle Ages, the banking panics of the 19th century, and the housing bubble of 2008, they are all different expressions of the same system. In short, money isn't wealth. Real wealth is land, knowledge, skill, and independence, things that retain their value when paper promises collapse. Debt isn't neutral. The system is designed to favor lenders and the wealthy at the expense of ordinary people. Inflation isn't random. It's part of the system. The money in your account is just a number, part of a debt-based system. Understanding this is the first step to protecting yourself. Otherwise, you're just another player in a game where the house always wins. History guides us and shows us how this system works. If this perspective offers you a fresh perspective, subscribe. History holds the answers, and I'll show you where to look.